Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. I'm recording this a day late on Friday, May 23rd. It is one daughter's birthday, and it is a day after my daughter's graduation, so hence the delay here in getting this to you. But sure enough, it was worth the wait as we've had another announcement on tariffs just in the last hour, so I'm able to incorporate that into the podcast today. Let's get the slides up and talk us through the week we've had. So I've called today's podcast Sundowners and Bond Vigilantes. I've said sundowners as some of the big beautiful bill was less than beautiful for makers of solar panels, and indeed many of the leasers of those solar panels, represent 70% of the customers. It's suggestion that this will now lead to a full-time change in the business model for residential solar panels. So we'll come to that later. And of course, the bond vigilantes are the now well-known conscience, what I call it, of the economy, in that they do seem to be less optimistic around the outcome of some of these pronouncements and negotiations. And the bond vigilantes have certainly been keeping markets on their toes, second guessing central banks, second guessing fiscal prudence, and causing some consternation in markets as bond markets continue to be yippy. So that's the title for today. As usual, we'll be cycling through inflation, interest rates, equity markets, geopolitics, and other asset classes. We have a little bit of news on Bitcoin today. And we're initially going to kick off with the news that broke just as we were releasing last week's podcast, which was around the idea of the Moody's downgrade and what that meant for the economy. We're going to then return to those bond vigilantes and see how they are taking center stage. It wouldn't be a week in economy without talking about a week in politics. We'll talk about the big, beautiful tax bill that has now passed the House as of Thursday morning. And of course, we'll ask where do we go from here in terms of some of the asset classes and some of what we're seeing in markets. Starting with inflation, the message of last week was around the calming of inflation. We had shown the new CPI numbers, which had actually come in a little below estimates. That had given some cheer to markets. It had given, at least initially, some sense that the Fed could proceed with some easing, although we know it was being data dependent pending the results of any tariffs. But when we look at what's actually transpiring in markets, whereas we've had groups such as Walmart prevaricating as to whether they will pass through the tax hikes, and this was in response a little bit to some political blowback that it received. We've also heard about Apple perhaps not passing through all of the price increases. We have seen a headline that suggests that Nike is increasing its prices by up to 7%. We've continued throughout earnings season to see other outdoors companies report not exactly great earnings, and they've fallen in the double digits as they know that customer demand is likely to be spotty, and equally they don't know how much of the price that they can absorb. This is quite a double-edged sword, as if the likes of Walmart or Apple do not pass on price increases through tariff increases to customers. That, of course, means that they are, in the words of the president, eating the tariffs. But when a company eats the tariffs, that will essentially eat their margin. So that's likely to look less healthy for the company and certainly for the equity holders of that company. Perhaps it will be better for the consumers, at least in the short run. But there is nowhere really to hide from the effect of tariffs. Either it's going to affect the bottom line or it's going to affect the price. So at this point, it's quite difficult to avoid them. Looking around the world, the propensity for inflation to surprise cannot be forgotten this week, as we know that in the UK, there was a surprise rebound in inflation, which drove gilt yields higher again. And the rebound in inflation in the UK was to 3.5%. So that is a number that's getting out of the comfort zone. We know that somewhere between 2 and 3 was a level that at least central banks could be comfortable with, as it was suitably close to the 2% target. But 3.5 is definitely high. It was due to really quite an unexpected and unpleasant increase in home bills, utility bills for the average British consumer. So that did send some gilt yields higher again, basically investors voting with their feet, showing that they're not confident in the state of the economy in the UK. And the gilt yields there have been certainly a very difficult asset class to be exposed to, as they have constantly either taken the heat from bad news on the domestic economy to contagion from the global economy. And as we'll show later, that contagion continues to cascade throughout the global economy when it comes to government bonds. Staying outside the US, in Japan, inflation was climbing at the fastest rate in more than 2 years. This is also around the 3.4, 3.5% level. There are high food prices there. We saw that the price of rice has almost doubled in 1 year, clearly a staple in the Japanese diet. And we know that this is also going to add to the unpopularity of the Ishiba government in Japan. So having waited for inflation for so long, they're now getting an unpleasant shock. That, of course, is the nature of inflation. It is not easily harnessed and certainly not predictable. Moving to the effect of tariffs, and as I've shown, we haven't yet quite seen the effect of tariffs onto inflation. We can see that inflation predictions are rising. They're still just barely above 3% for 2025, but they are expected to incorporate tariffs and that's likely to hit. And as today's news flow shows, that obviously the expectations and markets were completely right to continue to be worrying about tariffs. And it's likely that the Fed is continuing to worry about tariffs. It has spoken about the potential for inflation to be more volatile going forward and for it to be susceptible to supply side shocks, which is what tariffs are. So we know that just an announcement today that Trump has warned of a 50% tariff on EU imports from next month. This is on top of the already existing imposed reciprocal tariffs that were imposed at the beginning of April. Why is Europe now in the crosshairs of the administration? It seems that they have not come to the table, to the bargaining table, quickly and with high enough conviction for the Trump administration. At this time, they have turned their sights from China, where the 90-day stay is still in place and will be likely until July or August even, given it was in place from mid-May. So that gives us a little bit of stay of execution on China. But now with the focus on Europe, this is likely to be bad news for European stocks. And even during the course of the day, we've seen European stocks react negatively to that. Moving to bonds, both the tariff news and how that's affecting the economy, that has sucked some of the enthusiasm out of the fixed income market. We also know that the tax bill, which we'll talk about a bit later, which is not doing much to ease the fiscal problem and in fact is likely to significantly add to the fiscal deficit, that's likely to be an issue when it comes to the ability of the government to get its house in order fiscally. The bond market doesn't like that. It was also exacerbated by a weak auction of government debt, which saw the Treasury yield 30-year surge above 5%, its highest level since 2023, and that then caused a resultant slide in the Dow. So we are seeing Treasury yields north of 5%. We're seeing the 30-year Treasury yields north of 5%. We're seeing 10-year yields well above 4.5%. This is all going in the wrong direction as far as the administration is concerned. It's going to be challenging for corporates, challenging for consumers with their mortgage payments, and ultimately it is probably a result of some technical factors at play. We've heard a new term this week, abusa, which is anything but the USA, and the sense therefore being that any safety asset but anything in the USA is a safety asset and worth buying. We've already talked about the improved demand for German bonds versus US Treasuries, and we know that the greenback has continued to slide, and that has been a story also of this week. So if anything but the USA is now the mantra of non-US investors, we can see why this technical factor affecting the demand for bonds is not likely to go anywhere soon. And as we'll also see, one action has an equal and opposite reaction. For now, some investors are taking solace in the positive relative strength of the equity market, but equally we've seen some bond substitutes as well as some safety assets seeing a rush of interest, such as gold. We've talked about that for months at this point, and then more laterally Bitcoin as perhaps that alternative to fiat currency, but still representative of a certain amount of risk appetite. Let's return to the starting point of where we were before this big, beautiful tax bill. We were looking at a deficit that was around 7% of GDP, or about $2 trillion. And it's expected that this current tax bill could add an additional $3 trillion to that deficit. So clearly heading in the wrong direction, not addressing the problem that was starting to be a nagging problem for bond investors and just general watchers of the economy. If we look now at what investors had said about the US tax cuts proposed in the big, beautiful bill, 75% of investors clearly watching both sides of the ledger, knowing that the tax cuts would very likely increase the deficit, a virtually a negligible amount suggesting it would decrease the deficit, and 14% suggesting it would have a neutral impact. And there we have the Committee for a Responsible Federal Budget estimating that the legislation will increase US national debt by more than 3.3 trillion over the next decade, that it would increase federal debt held by the public from 98% of GDP to a record 125%. So really crossing the Rubicon in terms of the percentage of debt to GDP. And this is certainly not affecting, as I said, the budget in the right direction, the budget deficit in the right direction. So as we speak, this bill has passed the House. One of the unintended, perhaps, or intended consequences of the bill, but the unintended consequences in markets is the removal of those subsidies around electric vehicles as well as solar panels, basically erasing some of the conclusions of the Inflation Reduction Act. So definitely not positive for those sectors, as we're going to show in a little. Just as a reminder, what do these rises in government bond yields mean? And the only beneficiary of this is likely to be pension funds who are enjoying a higher funded status. And this has been one of the silver linings, I'd suggest, of the higher yield environment. Moving to equity markets have had a bit of a sideways few days. There has been the news of the tax bill, and probably not expected that would pass. And then the news of the tariffs just more recently have caused stocks to fall. So we've also talked about those earnings that have been less positive, and then the bond activity sending a little bit of a chill through the equity markets. So not a very conclusive week when it comes to equity markets this week. Certainly the uncertainty that has been percolating through markets for some time has continued to be an issue. Moving to those solar stocks, when we look at simply a 2-day performance of the stock, and there's a chart on the page for those not listening, we can really see the savage nature of the fall that just occurred in those stocks on the 22nd of May. So just yesterday, Sunrun down nearly 40%, Enphase Energy losing 19%, and Next Era, the largest renewables developer in the US, falling by 9%. So this is just a continuation of the blows that the renewable power sector have endured since the Trump administration has come into power. And as we'll show later, that has had a direct knock-on effect on the demand for renewable funds, the renewable sector indices, as well as ESG funds. Looking at other news, I mentioned before that Bitcoin was increasingly seen as an alternative to fiat currency. That has topped 110,000, and the milestones keep coming. There has been positive noise around regulation and also just an increasing endorsement by the administration and their adjacent operators. So all of that endorsement, all of that increased use, just leading to a normalization of Bitcoin as a currency and digital assets more broadly. We have seen, on the other hand, the dollar testing its floor, the floor being about 1,200 in the Bloomberg Dollar Index. It's hovered, held above that for 3 years. It is back to that floor again. The last time it passed that floor was in the aftermath of COVID around 22. So we've had a stronger dollar since then, pretty much. And that is now perhaps a support level that will not be repeated. I mentioned I would show the demand for ESG funds. We know that outflows from those funds have been significant. I thought it was interesting to look just at how skewed the ownership of ESG funds is around the world. Absolutely dominated by Europe, always has been, at least in the last 3 years. The US holdings of ESG funds is about a fifth of that of the European holdings, and the rest of the world about a half of the US position again. So very much it's Europe that matters when it comes to ESG funds. We know that there is a redoubling of commitment in Europe to these investment areas. No sense of a pushback or reining in of commitments there. So perhaps that will be the area to which asset managers have to turn if they're looking to develop their funds. And that is it for this week. Slightly shorter. We at least got the news in about the new tariffs. I'd expect the outcome of that to be that we will have more posturing, more brinkmanship, and most likely another stay of execution on the European tariffs. I think after a while, the boy that plays wolf is a fable that we should recall, that sometimes the bluster and the threats, because we know the pattern of them being followed by retrenchment, albeit with some concessions, it's probably right to expect that we'll have a similar outcome this time. In terms of asset classes, clearly the nagging problem right now for investors is bonds. This is why when it comes to bond funds that are forced to crystallize losses, they will experience more volatility than pure buy and hold bond ladders at the moment. They're likely to be nagging. If that continues to be the case, yields continue to be high, there will be some pain on the side of borrowers, maybe they private equity backed borrowers or just corporate borrowers. And we've had a very sluggish house market in the US. The April housing market was one of the lowest in many years. It has not been the traditional healthy spring sale market. And with the mortgage rates coming under pressure and not falling as many expected they would, we think that this is likely to continue to place a chill through the market. So that's it for this week. Thank you, everyone.